Welcome students to Module 2 of the course where we take a look at the financial statements of a company. It has been said that accounting is the language of business, and probably more so than any other function in business, finance relies on the information conveyed in accounting. In this module we examine financial statements. For most of you, parts of this will be familiar given your previous study of accounting. Financial statement analysis won't provide all the information we need in finance. Normally, it represents only a summative information provided to the firm's shareholders and other stakeholders. It is very useful for investors and competitors, not so for firm insiders and for the types of internal decision making we will examine throughout the course. However, it does help managers understand the nature of the firm better, even if only from an external perspective, so that they're better equipped to use the substantial amount of information typically available within firms to the finance practitioner. So after completing this module, you should be able to understand why do we analyze financial statements, be familiar with the major financial statements of a company, understand what represents an inflow and outflow of cash, and perform ratio analysis. Why analyze financial statements? Financial statements offer us an insight on how a company is performing and allows us to find ways to improve areas of underperformance. For example, the Commonwealth Bank states on their website that in order to run your business better, you need to know 5 numbers, such as reconciled cash balance. In other words, how much cash do you have in the bank, taking in consideration any payments and receivables. The day's sales outstanding. For example, how long before customers pays their invoices. Another thing is the break-even point, or how many sales units are needed to be sold in order to break even. Not making a loss, not making a profit either. Also, margins are important. Things like gross profit to sales ratio to understand cost efficiency. And lastly, special industry numbers depending on the type of business, which allows comparison with competitors in the industry as a whole. All this information is derived from the financial statements, information which is crucial for the financial manager. The reason why finance goes hand in hand with accounting is that corporate finance relies heavily on financial statements prepared using the accrual-based approach. The accrual-based approach means that revenues and costs are recorded at the point of sale and when they are incurred, not necessarily when the firm receives or pays out cash. On the other hand, in finance, the focus is on analyzing the company based on the cash flow approach, looking at what are actual inflows and outflows of cash. Here, cash is king. So the financial manager looks at the financial statements prepared by the accountants and converts that information into cash equivalents to enable analysis of performance and decision making. These are the main financial statements of a company. We will focus only on 3 statements: the balance sheet, income statement, and the statement of cash flow. The balance sheet shows a snapshot of accounting value on a particular date at a given point in time. That's why it says balance sheet as at 30th of June, because it gives a view of the company's accounts at that date. The balance sheet identity states that assets equal liabilities plus shareholders' equity, or, stated in a different way, assets minus liability equals shareholder equity. So no matter how you look at it, the 2 sides must equal or balance, hence the name balance sheet. In the previous module, we mentioned that one of the financial management concerns is working capital management. Therefore, the figure managers monitor all the time is the net working capital, which is calculated from the balance sheet as current asset minus current liability. This value is very important to the managers because when positive, it is usually a sign that the firm is doing well. Also, you will see when you look at the financial statements, they contain lots of notes. These are very important as they provide detailed information on how the figures have been derived. Without the notes, the statements are meaningless. The notes are crucial to analysts and investors because it is the notes that will provide important information about the purchase or sale of an important asset or how the company's debt is raised or rated, for example. This is an example of a balance sheet. The left-hand side lists the assets of the firm. Current assets are listed first because they are the most liquid. Fixed assets can include both tangible and intangible assets, and they are listed last because they generally are not very liquid. The liability and equity, or the ownership components of the firm, are listed on the right-hand side. This indicates how the assets are paid for, debt or equity or a combination of both. Since the balance sheet has to balance, you will see that the item that fluctuates most to create this balance is the retained earnings account found in the shareholders' equity. We have learned that the three main decisions in corporate finance are the investment decision, the financing decision, and the dividend decision. The investment decision relates to the left-hand side of the balance sheet, while the financing and the dividend decision relate to the right-hand side of the balance sheet. The three most important things to keep in mind when examining a balance sheet is liquidity of assets, market versus book value of all balance sheet items, and debt versus equity, or how assets are financed. A liquid asset is one that is easily converted to cash without significant loss of value. Note the words without loss in value. Remember, we can convert anything to cash quickly if we are willing to lower the price enough. But that doesn't mean it is liquid. So the more liquid the firm, the less likely they will go bankrupt or go into financial distress. However, a firm can be too liquid. Excess cash holdings lead to overall lower returns. Short-term creditors like a company to have a large current ratio, meaning lots of cash. But that doesn't mean that excess cash is good for a company. These large cash balances have an opportunity cost. You might think, what can a company do with this cash if it was not sitting in the bank? Invest in profitable projects, pay off some debt, or pay some to shareholders in the form of dividends. Moving on to the concept of market versus book value. We know that current assets and current liabilities generally have book values and market values that are very close because they are very liquid. This is not necessarily in the case of other assets, liabilities, and equity of the firm. Assets are listed at historical cost, less accumulated depreciation. This value may bear little resemblance to what they could actually be sold for today in the market. Same with liabilities. They are listed at face value. When interest rates change or the risk of the firm changes, the values of those liabilities change in the market as well. Equity is the ownership interest in the firm. The market value of equity depends on future growth prospects of the firm and on the market's estimation of the current value of all the assets of the firm. Therefore, if I ask you a question, which is the more important to this decision-making process, market value or book value? Of course, market values are generally more important for the decision-making process because they are more reflective of what the firm is worth today or of what the cash flows would be today. The other important thing in a balance sheet is the debt and equity proportion. A firm can raise capital through equity issue or borrowing. The use of debt in the capital structure of a firm is called financial leverage. This is very important as the right balance between debt and equity is hard to determine. Having a large proportion of debt or financial leverage increases the potential returns to the shareholders. However, it also increases the possibility for financial distress and business failure. Income statement is also known as profit and loss statement or statement of financial performance, and it measures earnings over a period of time. It's stated as revenue minus expenses equal profit. Note that income appears many times throughout the income statement, measured as gross profit, operating profit, earnings before interest and tax, pre-tax income, and so forth. Profit is often expressed on a per share basis as well when we state the earnings per share or EPS. This is an example of income statement showing the different measures of income. First, we have gross profit, which is your sales minus cost of goods sold. Then we have operating profit, which reflects the profit generated from the sale of products. Earnings before income and tax, or EBIT, includes any other income generated by the firm. If there is no other income, EBIT and operating income are the same. We apply the tax rate to EBIT to find the current tax payable, which we deduct to find the net profit. If there are any preference shares, we deduct the preference share dividends to arrive at the profit available for ordinary shareholders. This profit can either be distributed to the shareholders or retained in the firm, or a combination of both. The difference between net profit and cash dividends is called retained earnings, which is added to the retained earnings account in the balance sheet. We mentioned earlier that financial statements are prepared using the accrual-based approach. This follows the realization principle, which recognizes revenue at the time of sale, whether it's cash or credit. This implies that costs are recorded according to the matching principle, that is, revenues are identified and costs associated with these revenues are matched and recorded. As a result, the figures shown on the income statement may not be fully representative of the cash inflows and outflows that occurred during the period. Expenses charged against revenues that do not directly affect cash flow, such as depreciation, are called non-cash items. When calculating the cash flow, these items are added back. Although financial managers are interested in the information contained in the company's accrual-based financial statements, their primary focus is on the cash flows. Without adequate cash flows to pay obligations on time, to fund operations and growth, and to compensate owners, the company will fail. Now we turn to the concept of cash flow, which is one of the most important information for a financial manager. You will see that in finance, it is the cash flow that matters most. You should think of cash flow of a business as money coming in and money going out. In the same way, we have the balance sheet identity saying that assets equal liabilities plus shareholder equity, so we have the cash flow identity which states cash flow from assets equal cash flow to creditors plus the cash flow to shareholders. Cash flow from assets is also known as free cash flows because it is the cash available to investors, the providers of capital. In other words, the cash that comes from using the company's assets is used to pay those that financed the assets, the creditors as we borrowed money to buy these assets, and the shareholders as they invested capital in the firm that we used to buy the asset with. We said that in every business we have cash coming in and cash going out. Any activity that generates cash is considered a source of cash, an inflow, and usually occurs when we sell something. The general rule is that when we have a decrease in assets, which is on the left-hand side of the balance sheet, or increase in liabilities and shareholders' equity, the right-hand side of the balance sheet, it means that there is an inflow of cash, or we have sold something. Easier to see why this happened with inventory in fixed assets. We sold some, therefore the balance on those accounts has decreased. But you might be confused about account receivable. Think of it like this. A decrease in accounts receivable means that all those sales that we did on credit are finally settled. So when accounts receivable accounts are decreasing, customers are paying their invoices, so money is coming in. Therefore, it's a cash inflow. The same logic applies to accounts payable. An increase in accounts payable means that the firm has bought on credit. In other words, they borrowed money, so cash has come in. It's a source of cash. An increase in shareholders' equity means the company has issued share. Therefore, again, we have had cash coming in. On the other hand, any activity that spends cash is considered a use of cash, an outflow, and occurs usually when we sell something. An example would be an increase in asset, buying inventory or fixed assets. Remember, an increase in accounts receivable would be a use, as we sold on credit or lend some cash to the clients, which is considered an outflow. Also, any decrease in liabilities, it's a use of cash, as we are paying the debts, thus reducing the balances in those accounts. A decrease in shareholder equity means that the company has bought back some shares. They've spent money, an outflow of cash. The balance sheet will show less number of shares outstanding. The differences between sources and uses must equal the change in the cash balance. So all these sources of cash and uses of cash, the inflows and outflows, are summarized in the statement of cash flow and are grouped into three categories: operating, investment, and financing activities. So operating activities includes net profit and changes in the most current accounts. Investment activities includes changes in non-current assets. And financing activities includes changes in notes payable, long-term debt, and equity accounts, as well as dividends. An important note here, because depreciation is a non-cash item, is it added back to operating activity to get a true picture of our cash from operation activities, and because depreciation is linked with fixed assets, it is also taken into consideration under investment activities as well. This is a summary of the cash flow statement showing the sources and uses, the inflows and outflows of each type of account, and how they fit into the three groups of operating activities, investment activities, and financing activities. So, for example, a decrease in accounts payable is considered an outflow and has a minus. Dividends paid, again, the firm is paying money, it's an outflow of funds. As opposed to an increase in long-term debt, when the firm borrows, it increases the debt account, therefore it's a source, an inflow of funds. This is an example of statement of cash flow that uses the current income statement and the two most recent balance sheet that we presented earlier. Note that there is an increase in inventory and asset account, which means during the year the company has purchased more inventory, and therefore this change in the account is deducted as it is considered an outflow. to arrive at the true cash flow from operating activities. Similarly, a decrease in notes payable means the company has paid off some debt, and this is considered an outflow, a use of cash, and therefore it is deducted in the statement. The decrease in shareholder equity means the company has bought back some shares. But note, to arrive at that figure, you exclude the changes in the retained earnings account from the balance sheet. The last figure in the statement, the net change, should match the net change in the entries in the balance sheet accounts for cash and marketable securities from slide 7.